Last time we kept things deliberately simple. One or two funds, real consistency, a platform that's easy to use. If you haven't watched part one, go do that first. This builds directly on it. So that portfolio been growing. What changes now? As your portfolio grows, a few things start to matter that didn't before. Cost efficiency at scale, more control over what you actually hold, and access to a wider range of funds that simply Robo Advisor app typically offers. That's usually the point people start looking at something like interactive brokers, IBKR, a self dedicated platform that opens up a much bigger universe of funds, including something we haven't talked about yet: Ireland domiciled UCITS ETFs. Here's the part that surprises a lot of people. If you're investing in US domiciled funds from outside the US, which is most NRIs, there are two catches. One, dividend withholding tax is higher. Two, and this is the bigger one, your US domiciled holdings count toward US estate tax exposure once they cross a certain threshold. Currently, around $60,000. That applies whether or not you are American, whether or not you are ever set foot in the US. Ireland domiciled USCITF funds sidestep both of these: lower withholding tax and no US estate tax exposure. That's exactly why a lot of NRIs shift toward them once they are investing seriously. I have already done a full video on exactly this: the withholding tax math, the estate tax threshold, all of it. Links on screen and in the description if you want the deep version. For today's, that's really all you need to know to move on. Once you have got that core one or two fund holding in place, you can start layering additional, more targeted portfolios around it. Think of your core holding as the foundation and everything else as satellite you add deliberately, not accidentally. The first satellite worth talking about is what I would call an aggressive portfolio, a small set of funds concentrated in higher growth, higher volatility areas. Let's look at three funds that could sit in a satellite like this: a semiconductor play, a broader AI theme fund, and a US tech sector fund. First up in the satellite lineup, SMH, the Van Eck Semiconductor UCITS ETF, launched December 2020, so about 6 years of history, and it's genuinely tiny by holding count. 25 names. This is about as concentrated as an ETF can get. SMH tracks US listed companies active in the semiconductor industries. Top 10 stocks make up 83%: Micron, AMD, Taiwan Semiconductor, ASML, Broadcom, Nvidia, Intel, Applied Materials, Lam Research, KLA, with only 25 holdings. Total, this is about as far from diversified as an ETF gets. Countries, mostly US, as you would expect, but notice Netherlands and Taiwan both showing up meaningfully thanks to ASML and TSMC. That's actually a bit more geographic spread than you would guess from a fund this concentrated by holding count. Sectors, there's really only one to look at here. This one is effectively entirely technology, no pretending otherwise. Coming to performance, just look at the numbers on screen for a second because it's enormous. Year to date, 83%, 5 year, 359%. But scroll to 2022 on the year by year table, this one dropped hard that year as well. Big swings in both direction. That's the nature of a pure sector bet like this. Verdict. Who's it for? This is a small, high conviction satellite position, not a core holding. For someone who already has a diversified base elsewhere and genuinely wants concentrated exposure to the semiconductor theme, understanding they could see a swing like 2022 again. Remember, 25 holdings, one sector, one theme. SMH doesn't diversify your risk, it concentrates your conviction. Make sure that's actually what you are signing up for. Next, AIAI, the LNG Artificial Intelligence UCITS ETF. This one is a bit different from SMH. It's not a pure semiconductor bet, it's the broader AI theme. Launched mid 2019, about 7 years of history, 53 holdings. It tracks an index of companies with a meaningful chunk of their business tied to AI, which casts a wider net than chip makers. AI tracks companies deriving a meaningful share of business revenue from artificial intelligence. AIAI top 10 holdings looks different from SMH's, Teradyne, Tempus AI, Lam Research, Credo Technology, AMD, Nebius, Asteria Labs, Palto Alto Networks, ASML, Marvell. Some overlap with the semiconductor names, but also a few you probably haven't heard of if you don't follow this space closely. Top 10 countries is still US heavy, but genuinely more spread out than SMH. Taiwan, Netherlands, China, even Cayman Islands, Germany, Canada, Japan, all showing up. This is more globally spread take on the AI theme than a pure chip fund gives you. Top 10 sectors, mostly technology again, but notice healthcare and finance showing up too. That tells you this fund is casting a wider net than a pure semiconductor fund. AI as a theme touches more industries than chips alone. Performance year to date is strong with 48%, though notice it's a different shape from SMH. Less extreme is still very much a growth theme return profile. 5 years is 127%. Year by year table shows the same pattern. 2022 was rough with negative 39%. The recovery years after did the heavy lifting. Verdict. Who is it for? A thematic satellite bet for someone who wants AI exposure broader than just semiconductor makers, healthcare and finance names included, and who is comfortable paying the highest cost on this list for that broader net. AIAI is a proof that AI ETF can mean five different things depending on who built the index. Read the holding, not just the ticker. Last one in the trio, IUIT, the iShares S&P 500 Information Technology Sector UCITS ETF, slightly less extreme than the first two, running since late 2015. So 11 years of history, 75 holdings. It tracks the technology sector within the S&P 500 specifically, a capped version, so no single name can run away with the whole fund. Tracks the US technology sector within the S&P 500, largest name capped at 35%, others at 20%. Top 10 holding Nvidia, Apple, Microsoft, Broadcom, Micron, AMD, Intel, Applied Materials, Lam Research, Cisco. Familiar names again. But notice this fund holds three times as many companies as SMH does. More breadth within the sector, even though it's still just one sector. Countries almost entirely US, barely a silver anywhere else, less geographic spread than SMH or AI gave you. Sectors, no surprise. This is basically all technology with a tiny bit of business services and materials mixed in. It's a sector fund doing exactly what it says on the label. Performance year to date is strong with 24%. 5 year number is substantial too, 167%. And since inception, over 11 years, that number is one of the biggest on the entire list. Look at it for yourself. Year by year table shows the same pattern we keep saying. One rough year, several strong ones after it. Verdict. Who is it for? IUIT sits in between the other two we just looked at, more concentrated than a broad market fund, but with more breadth than SMS 25 holdings. If you want broad US tech exposure without going all in on pure semiconductors, this is the kind of fund people reach for. IUIT is the middle child of this lineup. not as flashy as SMH, not as famous as a broad index fund, but quietly doing its job while the other two get all the attention. An aggressive portfolio like this one we just walked through, SMH, AIAI, IUIT, or some mix of the three, isn't for everyone, and it shouldn't be. It suits someone with a stable income, an emergency fund already sorted, and genuinely not just in theory. Comfortable watching a 20 or 30% drawdown without panic selling. If checking your portfolio during a red week gives you a knot in your stomach, this piece should be small or maybe not there at all yet. So now you have got your simple starting portfolio and potentially an aggressive layer sitting on top of it. In part 3, we are building out two more pieces, a steadier core portfolio and a dividend and value portfolio, plus talking about exactly how far you should take all of this because yes, there is such a thing as too many funds. Subscribe if you haven't already, and I'll see you in part 3.